Well, mortgage rates climbed again this week, and because of that, the conversation around future Fed rate cuts may have completely changed. So this week there was a ton of data, ton of news that if you're like our consumer, our client right now, you're sitting there, what the heck does all this mean? And this week we're going to break it down into some of the simplest terms so you can empower yourself and your clients to make educated decisions here now. So first and foremost, 30-year fix up, unfortunately, 6.57 compared to last week, 6.44%. And if you're following the media, following kind of the news wires, a lot of it is pegged that move to some of the inflation prints, which I would say is a half truth. Yes, is inflation driving some of the upward movement in rates, but it's not the whole truth, which gives me a ton of hope for where we expect things to land as some of this chaos cools down. So high level overview. This week we got CPI, Consumer Price Index report, came in Tuesday. Hotter than expected on both year over year, headline and core, and month over month. Now, historically speaking, we see a report like that and there is truth to it because in the past we've seen mortgage rates respond negatively. Well, the interesting part is as that report moved or dropped, mortgage rates did not fundamentally move. What happened 45 minutes later out of the Oval Office, conversation or comments around, hey, we're going to take this Iran war for as long as we need. There we saw oil shoot higher. We saw stocks tank. That's what moved mortgage pricing that day, Tuesday. Fast forward to Wednesday, we got wholesale inflation, PPI, producer price index. That was a showstopper. Higher by a lot than expected on both headline and core, both year over year and month over month. Why that's important and why it moved the market so much, what the producer pays, so that production aspect, it goes higher. Who pays the end price? The consumer. So the expectation is, hey, what does this translate into from a future standpoint of inflation, volatility there? Layer in on top of that, we got retail sales, jobless claims that were in line with expectations, but more teetering on the side of, hey, the economy may not be as strong as we expected. And layer all that in top of, hey, what does the Fed do from here? Oof, with higher than expected inflation, can't really cut, can't really raise. So there's a lot of pause, which in turn creates uncertainty on that side. Layer on top of the geopolitical tension, oil doing what it's doing. We have a summit going on underway right now in China, which the expectation is, hey, we could see a potential location for a peace deal come out of it. Put all this together, short term rates are moving based on headline volatility. Hey, we're in the war, we're out of the war. You see that response immediately. We're in the war, rates get worse. We're out of the war, rates get better. So until we get that noise, if you want to call it, turned down, the volatility that we're seeing in rates is going to be here. Long term, if we start to see inflation kind of cool down, moderate, the long-term aspect of rates is going to improve. Now, the important part and the takeaway for our clients right now is timing the interest rate is going to create massive heartburn. Being prepared and educated is where you're going to see success. If you're running into challenges with communicating this message or preparing your client for that moment, reach out. We're here to help. As always, let's make it a fantastic Friday and an even greater weekend.